The S&P 500 has had a cracking year, up 22% year to date. Furthermore, in 2023, it was also a very, very good year. And if you measure the return since the 1st of January 2023, that has been over 50%. Investors are extremely optimistic with the index consistently hitting new highs. But this begs the question, are we a little bit overextended? Is it time for the S&P to have a bit of a correction, for things to consolidate a little bit, or is there a big crash coming? My personal view is that whilst the S&P has had a very good run, it's now getting to that point where it's overvalued and there are a lot of indicators that are flashing bearish. So therefore, I'm taking a more cautious view on the market and positioning myself ready for a downturn. In this video, I will explain why. This chart shows us the 10-year rolling average of the S&P 500 since 1928. And what you can see here is at the peak of that normal distribution, you've got that 8 to 10% a year range. Many people will notice that in my discounted cash flows, I don't use a weighted average cost of capital to calculate my discount rate. But what I actually do is I just say 9%, because 9% is the opportunity cost and what you're likely to get investing in an index like the S&P over the long term. Now, since 10 years ago, October 2014, the S&P 500 has returned 206%. So it's basically tripled, which is very, very good as an investor. Now, if you annualize that, you get 12%. So already on this bell curve, we are slightly to the right of where we should be. Quite significantly, actually. I mean, in terms of percentiles, we're at a pretty high percentile there, suggesting that the S&P has beaten its 10-year average by quite a bit, and we may be due a correction. However, if you look at the returns over the last 10 years on an individual basis, you'll actually see that since 2019, we've had 6 really good years, including 2024 year to date, and we've only had 1 bad year, meaning if you average these 6, it would actually add up to a lot more than 12%, suggesting that we're actually very far to the right of this bell curve. You know, you've got from 2015 to 2018, 3 of those 4 years would have pulled that 12% average down quite a bit. So for the last 6 years, we've had a very good return. We've had a good return, but does that mean that we're overvalued? If you look at the price to earnings for the S&P 500 over the long term, that has steadily increased over the past 60 years. Now, one thing to mention here is I do cut this some slack because nowadays we've got a situation, companies like Microsoft, Nvidia, Amazon, the big tech companies make up a very, very high proportion of the index, and they typically have higher price to earnings ratios because they're growing faster. In the 1990s, the top of the S&P 500 was more comprised of, companies in the oil sector and the banking sector, which were more legacy companies that typically didn't grow as fast. So over the long run, I think we can cut the S&P a little bit of slack for having a marginally higher PE. But if you look at the ratio since 2015, when these big tech stocks were pretty much all at the top of the index already, you can see that we are definitely at elevated levels in terms of a PE. If you look at this chart, the median for the last 10 years would be about 22, but we're at 30, and we've accelerated up from about 20 towards the end of 2022. Another thing to note here is the growth rates of many of these big tech stocks were actually faster in the period from 2015 to 2021 than they are in 2023 and 2024. I think this is partially to do with the fact that we're in an AI arms race at the moment. These companies are heavily investing, particularly sacrificing quite a lot of growth on the bottom line in order to generate superior returns through innovation and new artificial intelligence technology over the next 10 years. So this data is showing that the S&P 500 is expensive on a PE basis. And again, I'm not using price to sales so much for this because again, the big tech stocks that are making up a greater percent of the weighting, they have much higher margins than the stocks that were, at the top of the index in the 90s, for example. So actually looking at on the bottom line is the best way to do it. As well as this data, I just get an intuitive feeling that everyone is really bullish about AI, and I'm bullish about AI as well. Everybody is so bullish about the Fed pulling off their soft landing and everything continue to grow and, Everyone was very, very bullish in 2021, and then we had a big crash. Everybody was so bullish in 1999, and then we had a big crash. Everyone was so bullish in 2006, 2007, and then we had a big crash. And it's just that intuitive feeling that you get where you think, everyone is so bullish, the S&P is going up month after month after month. When will this end? Now, data to support the bullishness is in the AIII, the Investor Sentiment Survey, and you can see over the past 6 months, pretty much consistently, there's been a very, very wide gap between bullish and bearish, a very, very wide gap with, sometimes in some weeks, over 50% of investors surveyed saying they're bullish, which is pretty much at its all-time highs. If you look at it over a longer period of time, so if we extrapolate this back over sort of the last 15 years, you can see the blue and you can see the red and the yellow. So this is neutral and bearish, consistency below this blue. We've had a very, very long, consistent period of ultra bullishness. And it's actually an inverse indicator because you can see in 2021, we had the same sort of 6-month period of ultra bullishness and then the market crashed. You don't want to be fully invested when your taxi driver, your hairdresser, and everyone under the sun is all investing. And everyone under the sun are all investing and telling you to buy Tesla and Palantir shares. If you look at this chart that was very nicely put together by Game of Trades, you can see the AAII bulls 50-day moving average. So that smooths out that very volatile chart quite a lot. And it looks at the 50-day moving average of the percent of investors that are bullish. And you can see back in 2007, it hit a bullish peak. And then obviously we had a massive crash. And then by the time it got negative, that's when the market had a really good return in 2009. Now, what happened again, it's the same thing again. In 2021, we hit sort of bullish highs. It was pretty much the highest that it had hit since that 2007 period. And then we had a massive crash. When everyone was panicking and there was blood on the streets, that's when the market bottomed out because all the investors are selling out, which coincides with the market crash. And when everyone is bullish, you need to keep finding new people that are bullish to keep pulling the index up. When everyone is bearish, there's only so many more investors that are going to sell out, right? And then when the new money flows in, the market goes up. So that's why this index is basically contrary. But you can see now we're at bullish highs. And then in red, you've got the market declines of the S&P perfectly marked. So all I'm saying is that I feel extreme bullish sentiment right now. The S&P is at very, very high levels. And actually what's also interesting is the S&P hit a high in 2000, right? It then took 6 years until 2006 for the S&P to then make a new all-time high. Then the market crashed in 2008, and then it took another 5 to 6 years for the S&P to make a new high. Since December 2021, that was pretty much the peak. The S&P has not only passed that high, but is already 20% above that high. And the S&P hadn't had a huge correction for a very, very long time, suggesting as well that there is extreme momentum in the market, which makes it very expensive. And we're going to have to find new bullish money all the time to keep inflating that market and pushing it up and up. Instead of just looking at a single leading indicator which predicts recessions, I like to look at an aggregate of many. And that's what the Conference Board Leading Economic Index does. It aggregates many, many factors which typically lead a recession. So these things start to show deterioration in an economy before a recession. And you can see that, it dipped massively in 2001. Then we had a recession. It dipped in 2007, 2008, and we had a recession. Anytime where there's a big dip, that dip sort of precedes a recession. 2020 was a little bit of an anomaly. We were going to have a recession, and then it was effectively saved by unprecedented monetary stimulus. But what's interesting is that we've seen a big decline in this Conference Board Leading Economic Index, and we have not seen the recession happen just yet. Many people may be saying, what recession? What recession do you mean? The GDP seems fine. The economy is growing strong. The thing is about GDP is that is typically, it's much slower because GDP is an aggregate of all of the output within an economy. The whole big figure tends to move much slower than, say, for example, the stock market, which would actually pick it up before. So you've got these immediate indicators where they will signal it coming, and GDP actually tends to lag a little bit. You'll see, for example, when we look at 2007, the stock market had peaked by 2007. There were signs in the mortgage market that were showing a lot of declines, but the GDP figure actually didn't go negative until Q4 of 2008. Now, by early 2009, the stock market had already bottomed out and was rocketing up when the GDP numbers were showing that we were still in a recession. So whilst the economy looks strong on a GDP basis, this isn't an accurate measure of the general health of the economy in the next year. We need to look at leading indicators, which is what the Economic Conference Board does. Another thing that I think is going to start really flowing through the economic data is many consumers just squeeze because, it's the same with if you look at the total debt balance, for example, it's at 17 trillion, right? It was at close to 13 trillion at the peak of the global financial crisis, which when you adjust it into today's terms, is pretty much the same. We're pretty much back to where we were. If you go back a few years, we're actually much lower than the GFC. And then we got past that GFC, but adjusted for inflation, it was still lower. But now we're pretty much back to where we were at the peak of the GFC in terms of total debt balance. Now, the problem that we've got, obviously, is interest rates were held really, really low at 0.25% for so very long. And people got used to this for very, very long. It peaked at 2.5% for a while, but then it got cut straight back down all the way towards zero when we were in the pandemic. And the problem is that if you put interest rates up from so low to so high, the monthly payments that people are having to pay, because they start from such a low base, it inflates asset prices. And then when you put them up so much, so fast, people, they need to have a complete and utter reset because they can't adjust to the changes in payments. Like, for example, even if you look at the 30-year mortgage rate, which historically, mortgages are at very low rates and nothing like auto loans. But if you look at it, for sort of the last 15 years, people were very comfortable with roughly a 4% mortgage rate. But you can see now, let's say your mortgage payment, 4%, and let's say it was at $2,000 a month. Even if it's gone to 6%, and look, it's been at 6%, it's been above 6% pretty much for all of the last 2 years. At 4%, if it was 2,000, at 6%, it would be 3,000, right? An increase of 50%. And it's just crazy, people are leveraged in so many ways these days. How are they adjusting to this increased rates in an economy that is pretty much as leveraged as it was in the global financial crisis? I understand that we're not as leveraged as we were in terms of housing, but in terms of credit, general credit cards, auto loans, that kind of thing, the economy has got much more leveraged. And I know what everyone is saying. Everyone is going to say, oh yeah, we are cutting rates again, which will help. Now that's true, but we've kind of been in this situation before, right? You can see here, who's this by? Real Investment Advice. Thank you for the chart. This chart, it says, buy Fed rate hikes, sell the first to last cut. So let's look at 2006, 2007. The stock market, the S&P 500 in black, was going up and up and up as rates were going up. And then look, right at the peak of the stock market was the peak of where the rates were. They started cutting the rates, and as the rates came down, then boom, we entered a recession. It was the same thing in the dot-com crisis. When they started to cut rates, boom, that's when we entered a recession. What you notice is that it's not so much, obviously rate cuts don't cause a recession. Rate cuts are a response and they stimulate the economy, but it's these very, very steep rate hikes that then have a delayed impact that then ultimately impact the economy and therefore the stock market. That's what we need to be careful about here. And look at it. I mean, compared to the GFC, where we went from 1 to 5, we went from 0.25 all the way up above 5. And this is where the stock market is at incredible, incredible highs. This chart is old. You see that peak where it says question mark, question mark, question mark? We're 20% above that peak now. So the stock market is extremely high, and we've just had this huge shift in cuts You can also see this is the yield curve, and that inverted. It not only inverted, but inverted deeply. And again, the gray bars are recessions. And what typically happens is that you see an inversion in the yield curve where people buy up long-term treasuries, short-term treasuries. The prices are coming down because the yields are coming up and people are buying long-term. So that pushes the price of the long-term up. And therefore the yield that you get on a 2-year then ends up being more than a yield on a 10-year, which is unusual because for a 10-year, if you want to obviously exit before maturity, you've got to lock up your money for 10 years or end up risking your capital. Now, what we've got here is a deep yield inversion, and then you can see the pattern, the gray bar being recession, as I said. You come out of the yield curve inversion, we typically get a recession. It hasn't failed yet. Now, you could say this time it's different. This time it might be different. I'm not saying that we're in the world's biggest bubble and we're going to have a 50% capitulation in the stock market. I'm just saying that the stock market is incredibly high given a lot of this data pointing to bearish signals. You know, we've had a very deep yield curve inversion, and sure, it doesn't automatically predict the recession is going to happen the next month or the stock market is going to crash in the next month. You know, I'm just saying over the last 50 years, every time we see a dip in the yield curve, and then at some point later, at some point in the next 6 months to 2 years, then we see the recession coming. I wanted to mention my opinion because obviously in the past few months, I've posted a lot of videos on stocks, some of which I'm very bullish on, and most of the stocks that I talk about on this channel I own, and I've got a significant amount of my capital in those stocks. So I just wanted to also make it clear, you know, stocks are not always going up. I wanted to make it clear that in the past 1 to 2 months, I've really sort of been changing my stance, and I've been getting a bit itchy, a bit sort of cautious about being very fully invested. I went through this in 2021, where in sort of early to mid 2021, I started exiting a lot of my positions. By July 2021, I was short the market in terms of put options, which I do not encourage anybody to do. I wasn't short the S&P 500 or any indexes. I was short more speculative stocks that I think are very overvalued. So I'm just saying, when we've had such a time of extreme optimism, 50% return on the S&P in less than 2 years, a lot of indicators pointing to extreme optimism in the market, but the actual data showing that, you know, let's proceed on the side of caution here, I think it's worth taking some chips off the table. That's not my advice. I'm just saying that's what I'm doing. I've sold out of stocks that have done very well. For example, Palantir was a large position of mine. My average cost basis on that was about $15 a share, where it was trading at 15 times sales. Now it's trading at 40 times sales. Isn't that crazy? 40 times sales. Even with 33% margins, which I think Palantir are actually close to that, you're talking 120 PE, 120 times free cash flow. These are very, very, very high numbers for stocks. You know, Palantir could crash 50%, and people could still make the case that it was overvalued. I wouldn't say objectively it was particularly undervalued when I bought it. Now, this is the other thing to consider, because a lot of people say time in the market beats timing the market. Now, that is very true, depending on how you're involved in terms of investments. You know, if you're someone who goes about their day to day, they've got their own business, which isn't correlated in the sort of financial or investment world, and you're making money in that way, you're absolutely right. Like, just buying and holding really good quality companies that you understand is the best way to do it. I'm also saying that when the market's overvalued, it's not a case of, oh, if the market goes up another 5-10% in the next few months, I'm wrong and it's all time to panic. And then what? Then you end up buying the index. Then it crashes, you change your mind and you sell. Then you think, oh, it's going up. Like, this is where investors lose money. If you're going to take a bearish stance, you've got to say, look, this could happen. But as I said, look at the yield curve inversions, for example. The recessions happen between 6 months and 2 years later. Look at the sentiment survey. The peak bullishness was in August of 2021, right? The S&P didn't start crashing until 6 months later in January. So if the S&P goes up again, which it did, all the way until the end of the year, you don't panic, you know? And I had put options that had lost 70% of their premium, and I stuck to my guns, and in January 2022, everything turned around. I'm not saying I'm massively short the market. I'm not saying I'm not invested. I'm very much long a lot of companies for the long term, but I've sold out of a lot of my investments that have done very, very well. A lot of the ones that I bought in 2022 and some of them in 2023. And I'm just taking a bit more of a cautious stance, because the other side to timing the market and a pro for timing the market is, let's say if you couldn't avoid a 25% crash in the market, and I'm not saying the market's going to crash by that much, but if you couldn't avoid that, you would need to make 33% just to get back to where you got. If it was a 50% crash, which is extreme, and I don't think the market is going to crash 50%, you'd have to double your portfolio just to get back to where you started. So, I was in a situation where I felt the numbers with my own eyes, where my portfolio was up significantly in 2022. It wasn't up very much in 2021 because I was sort of short and long a lot of value stocks. But 2022, I was short, made money, revolved that over to long throughout the summer and the autumn of 2022, then made money in 2023. And, you look at compound interest. If you can compound yourself at 20% plus without having those huge drawdowns that then knock it back, it's amazing how much money you can make. And again, I'm not saying the market is definitely going to crash. My point is that looking at the data and looking at where we are and looking at how much of a run it's had, I think taking at least some chips off the table and having some liquidity to buy when there's blood in the streets. That's the other thing. If you're someone who's earning a massive surplus of money and you're just dollar cost averaging into stocks all the time, great. If you're someone who's constantly managing a relatively large portfolio, you want to take those chips off the table, because that is your firepower when there's blood on the streets. When there's massive down momentum in the market, then to dollar cost average with that cash that you sold out from at the top is a good strategy. But unless you've got the right mentality, unless you can handle it, don't time the market. For the average person, an S&P 500 index fund and a couple of stocks that you know really well for the long term, that you're not going to get too twitchy over if they move and if they're volatile, because you understand for the long term, that is perfect. I just wanted to make my stance clear that whilst I'm bullish on all of the stocks that I've said that I'm bullish on my YouTube channel, I'm long all of them, apart from Duolingo, which I sold at an increased price. I just wanted to make it clear that I am taking some chips off the table. It's been a really good couple of years. I'm up 46% year to date overall in my portfolio. Very, very happy with that. And I'm just taking a few chips off the table because I think in the next couple of years, there will definitely be some sort of correction that will allow me to put that cash to good use when equity prices are of better value. Thank you very much for watching.